What makes one stock a good dividend investment while another stock might just be meh, okay, or a bad investment? Hey guys, I'm Jasper, a financial market analyst working with Trading 212 to help improve your financial education. Investing in stocks to earn a return through dividends can be an excellent way to generate passive income and build wealth, and it requires relatively little upkeep. Now that's all well and good, but you need a good dividend stock to pay good dividends. So today I'm going to talk about the important characteristics that make a good dividend paying stock, the kind of stock that you'd want to keep in your portfolio year after year. Specifically, these characteristics fit two camps: qualitative and quantitative. Qualitative is basically looking at the business itself and what it does, and is more subjective. Quantitative is all about the numbers with a bit of maths mixed in. First, I'm going to cover the qualitative characteristics. So back in 2007, when I was sitting in a skyscraper in Midtown Manhattan, training to be a stockbroker, I learned about the real workings of the stock market for the first time. It was so I could pass the exam to earn myself the so-called Series 7 license to sell stocks. Once I'd passed and was actually on the phone talking with potential clients, my boss had given me a specific strategy. It was impress the client by recommending a high-performing growth stock, then once I'd proved myself in the mind of the client, encourage them to move their blue-chip dividend-paying stocks to the brokerage I work for. Interestingly, this is the opposite of the Wolf of Wall Street tactic of first offering clients a blue-chip stock before flipping them into pink sheets and penny stocks that earn very high commissions. Actually, neither approach really has the client's best interest at heart, which goes some way to explain why I'm not still a stockbroker now and why commission-free investing firms like Trading 212 are so popular. So why do I mention all this? Well, actually it's to demonstrate in a roundabout kind of way the first qualitative characteristic you should look for in a good dividend-paying stock. The company should not be the kind of exciting opportunity that stockbrokers would call you about. The company must be stable. Think about it for a minute. What makes a company exciting? It's the growth potential. That means if investors make money in an exciting company, it will be through the growth in the share price, not through the dividends. Remember our objective here. For our dividend investing portfolio, we don't want to be constantly following the market with sophisticated techniques. We want to be long-term passive shareholders directly benefiting from the profitability of the company through its dividend. Dividend investors are generally looking to avoid risks and excessive price fluctuations so they can comfortably grow their portfolio over time incrementally. Understanding the stability of a company and the stability of the industry it operates in doesn't have to take forever, but a combination of research and common sense is needed. The main point is you need to get to know the company and what it does and decide whether it's a business that has good long-term prospects. But I'm not a stock market analyst. How can I do that? I hear some saying. Well, two things. Number one, analysts often get it wrong. And number two, judging whether a business has good long-term prospects is much simpler than trying to predict the next stock that will go up 10x in the next 12 months. We just need to find companies that produce goods and services that will still be needed years from now. Warren Buffett has held shares of Coca-Cola since the late 1980s, and the company accounts for about 8.5% of Berkshire Hathaway's portfolio at the time of filming. Now, if I pull up the Trading 212 app, I can search for Coca-Cola. Now, I know we've all drank Coke and know the brand, but just to give you a little bit of a flavor of the kind of things that give the company stability. If we scroll down a moment, 79,000 employees. This is a huge company. It's in the consumer non-cyclical sector, which is generally seen as defensive in a portfolio, and it's in the beverage industry, which is stable. Not to say that there aren't unstable beverage companies, but this is a stable industry to be in. We all need to drink, right? Let's read these company details a little. It basically operates in all continents. It owns major brands, Coca-Cola obviously, Sprite, Fanta, but also Costa Coffee, Vitamin Water, Minute Maid, etc. So there's a huge diversification within the beverages, and again, operates in 200 countries. The other thing you'd ideally do is read the annual report, which if you scroll down to the instrument details, you can find here, or my preference is to listen to the conference call, which management will hold after releasing quarterly earnings. And here you can hear what the management is aiming for, and you'll also have analysts asking different questions about different segments of the business that are currently important for the company. It really doesn't need to take more than a few hours to learn about a company that you might end up being invested in for years, even decades. Next, let's move on to the quantitative characteristics of a good dividend stock. These are 5 tools I use to pick a good potential dividend stock. Dividend yield. This is probably the most basic tool for filtering dividend stock choices. It's calculated by dividing the dividend by the stock price and multiplying by 100 to get a percentage. It's how much return in dividends you'll get from your investment in a particular stock. So if the share price is $100 and it pays a dividend of $5 a year, then the dividend yield is 5%. So for reference, dividend yields typically are below 5%, with the average of the FTSE 100 at 4.2% and the S&P 500 at 1.8%, or at least before COVID. Before I move on to the next item, I want to emphasize that one of the things you really want to avoid is what is called a dividend trap stock. It's a trap! These stocks pay a high dividend and look like great investments if you're only looking at the dividend yield. That high dividend acts like blinkers over people's eyes. They see the big returns and they miss some big underlying issue with the company. Point is, it's not advisable to only apply one criteria when you're looking for dividend stocks. Instead, we want to include multiple techniques that can help identify good stocks and give us the best chance of filtering out the bad ones. Dividend growth rate. Although we want stable companies, one thing we don't want to be stable is the dividend payout. We want companies to increase their dividend over time, not just because we want to earn more, which of course we do, but we also want to try and keep pace with inflation. So what we can do is check a company's history to see its history of dividend payments. What we want to do is see if it has been raising its dividend and by how much. If I jump over to a handy website like Dividend.com, I can show you the payout history of Coca-Cola. I like this website, but there's lots of information on different kinds of sources. Let's scroll down to the bottom. We start in 1995. Here we can see it's about 5 cents. In 1996, it moved up to 6 cents. We can go up to 2000, the dot-com crash. It still raises the dividend from 8 to 8.5 cents. Let's go up to 2008 and the financial crisis. It went from 19 to 20.5 cents. Now by 2020, it's the COVID crisis and the dividend gets raised from 40 to 41 cents. Of course, the past isn't necessarily a prediction of the future, but at least demonstrates that the company is capable of doing what you need it to do, re the dividend. Payout ratio. Since dividend investing is all about holding for the long term, we want to make sure a dividend stock will continue to pay a good dividend. One of the ways to do that is to check the payout ratio, which is what percentage of the company's profits are paid out in dividends. Usually companies try to keep it in the 40 to 50% range. That means more than half of the company's profit is reinvested into growing the company. Generally speaking, if the payout ratio is low, the more sustainable the dividend is over time. But this often means a lower dividend yield too. This is the balance we need to strike. Debt to profit. Another potential threat to a company's stability and its ability to pay dividends consistently is if it has a lot of debt. A company with too much debt may at some point, especially if interest rates are going up, be forced to pay off its debt instead of paying its dividends. The debt to profit ratio is often called gearing or can be seen in corporate reports expressed as debt to EBITDA. Generally, the lower the gearing, the less risk the company carries. Sometimes raising money through debt makes sense. If it means taking advantage of low interest rates, for example, or to increase productive capacity. So having debt isn't necessarily a bad thing. What matters is that the company can pay the debt and it is being used to grow. Price to earnings ratio. If there's one ratio that people tend to know about, it's the PE ratio, and for good reason. This is the ratio between the price of the stock and its earnings. High PE ratios over 20 typically mean a stock is overvalued, while low PE ratios closer to 10 mean a stock is undervalued. Growth stocks tend to have a high PE ratio because they are not earning a lot, because all the money they have is being reinvested into the company to help it grow faster. So that's fine. But like I talked about at the start, we are not looking for high growth opportunities here. We want companies with stable earnings. If we are going to hold on to the stock for a long time, we don't need to go bargain hunting necessarily, but we don't ideally want to buy a dividend paying stock with a high valuation because we know its growth doesn't justify it over the long term, meaning the share price has a higher chance of falling while we own it. All right, let's recap. We talked about the qualitative features of a company, many of which were exemplified by Warren Buffett's favorite Coca-Cola. And we talked about the 5 quantitative measures, the dividend yield growth rate, payout ratio, debt to profit ratio, and the price to earnings ratio. This is by no means an exhaustive list of all the tools available to help you decide which stocks to pick for dividend investing. I highly recommend you use these tools and more before making a decision. But what do you think? What's your favorite technique for finding a good dividend paying stock? Please share it with the 860,000 and growing Trading 212 YouTube subscribers by dropping a comment below. And if you like this video, please make sure to smash the like button, subscribe and hit the bell icon so you can see more videos like these as soon as they're released. Thank you very much for watching and happy investing.